While much of the financial world spent the past year arguing about technology stocks, artificial intelligence, and the next big digital trend, a far quieter story unfolded in the background. It did not rely on excitement, narratives, or speculative enthusiasm. It relied on something far more persistent: mathematics. Silver, long dismissed as a secondary asset, rose roughly 115% in 12 months and now trades near $66 an ounce. At the same time, the gold-to-silver ratio fell sharply to around 65. These moves were not random, and they were not driven by hype. They were the result of a long-delayed adjustment. When an asset more than doubles in a year, it deserves to be examined calmly and in context. Over the same period, the S&P 500 produced respectable but modest gains. Savings accounts offered returns barely sufficient to protect purchasing power. Bonds struggled. Traditional balanced portfolios did what they usually do in uncertain environments. They preserved capital, but they did not meaningfully grow it. Silver, by contrast, quietly rewrote expectations. If someone had placed $10,000 into silver a year ago, that position would now be worth more than $21,000. There is no bank product, no guaranteed interest rate, and no conservative yield instrument that can replicate that outcome. That comparison is important because it highlights the difference between price movement driven by speculation and price movement driven by structural forces. Speculation fades quickly. Structural repricing does not. Silver did not suddenly become valuable. It has always been valuable. What changed was the market's willingness to recognize the imbalance between supply and demand. For years, the silver market ran deficits. Global consumption exceeded mine production and recycling on a consistent basis. Those deficits were easy to ignore when prices were low and attention was elsewhere. But deficits do not disappear simply because they are inconvenient. They accumulate pressure, and eventually that pressure must resolve through price. One reason silver is often misunderstood is its dual role. It is not just a precious metal held for protection against monetary instability. It is also a critical industrial input. Solar energy depends on it. Electric vehicles depend on it. Advanced electronics depend on it. These are not optional uses, and they are not easily replaced. Silver's conductivity, reliability, and durability make substitution difficult and often uneconomic. This creates a demand profile that behaves differently from most commodities. When prices rise, demand does not collapse. Instead, industrial users adjust behavior. They prioritize supply security. They increase inventory buffers. They lock in contracts. In doing so, they remove physical metal from the open market. Each ounce secured for production is an ounce unavailable for investment or trading. Scarcity builds quietly, and then all at once, it becomes visible. At the same time, investors begin to take notice. When an asset delivers returns that outperform stocks, bonds, and cash simultaneously, it attracts attention from capital allocators who previously ignored it. This shift matters because silver's market is small relative to most financial assets. It does not take massive inflows to move the price meaningfully. A modest reallocation from large portfolios can have an outsized impact. The tightening of physical inventories adds another layer to this dynamic. Exchange-registered silver stocks have declined significantly, representing only a short window of global industrial consumption. When deliverable supply falls while demand rises, the market has only one mechanism to restore balance: higher prices. Paper contracts can delay this adjustment, but they cannot eliminate it indefinitely. Eventually, physical reality asserts itself. One of the clearest signals of this shift has been the behavior of the gold-to-silver ratio. Historically, during periods of monetary stress or precious metals bull markets, this ratio compresses. A year ago, gold traded at more than 80 times the price of silver. Today, that number has fallen substantially. This tells us that silver is not merely rising alongside gold, it is outperforming. This relationship matters because gold is already performing well. It has reached new highs, driven by central bank demand, geopolitical uncertainty, and long-term concerns about currency stability. Silver tends to follow the same macro forces, but with greater volatility. Its smaller market size amplifies both gains and losses. When capital flows toward precious metals broadly, silver often responds with greater intensity. Simple arithmetic helps clarify the implications. If gold continues higher and the ratio continues to normalize, silver prices well above current levels are not extreme projections. They are mathematical outcomes. This does not mean prices move in straight lines or without setbacks. It means the long-term path is shaped by forces that are slow, persistent, and difficult to reverse. Another concept worth understanding is inelastic demand. In economics, this describes situations where consumption does not fall significantly as prices rise. Silver fits this description in many of its most important uses. Solar manufacturers cannot simply remove silver from panels without compromising efficiency. Electronics producers cannot replace it without sacrificing performance. When prices rise, these industries do not step away. They adapt by securing supply. That adaptation often takes the form of stockpiling. When executives realize that a shortage of silver could halt production, cost becomes secondary to availability. This shift in mindset transforms silver from a cost input into a strategic resource. Once that happens, demand becomes less sensitive to price and more sensitive to risk. Markets tend to underestimate how powerful that behavioral change can be. Investor psychology adds yet another layer. For years, silver attracted little attention. It was considered boring, stagnant, and unproductive. As prices moved from the teens into the 20s, interest remained limited to enthusiasts. At higher levels, especially after triple-digit annual gains, silver enters a different psychological category. It becomes visible. Visibility attracts participation. As participation grows, physical demand often increases alongside paper demand. Retail investors seek coins and bars. Premiums rise. The gap between paper pricing and physical availability widens. This divergence signals stress in the system, not excess. It indicates that ownership preferences are shifting toward tangible assets rather than claims. Those who accumulated silver during years of stagnation tend not to sell quickly. Their conviction was built over time, not excitement. This reduces supply precisely when new buyers arrive. The result is a market where available ounces shrink even as interest grows. That is not a recipe for stability at lower prices. None of this implies inevitability or certainty. Sensible analysis always includes risk. A strong currency environment, sharply higher real interest rates, or unexpected technological breakthroughs could alter the landscape. Supply can respond over time, though mining projects take years, not months. Demand patterns can evolve, though substitution in silver's key uses remains challenging. What matters is not predicting exact prices, but understanding probabilities. Silver's recent performance reflects a repricing driven by long-term imbalances, not short-term enthusiasm. Those imbalances are still present. Structural deficits do not resolve quickly. Industrial dependence does not vanish. Monetary pressures do not reverse easily. At $66 an ounce, silver does not resemble a final chapter. It resembles a recognition phase. The market is beginning to acknowledge what patient observers have understood for years. The difference between being early and being wrong is often time. In this case, time has begun to favor those who focused on fundamentals rather than fashion. The disciplined approach remains unchanged. Accumulate thoughtfully, size positions responsibly, favor assets that make sense across multiple scenarios rather than those dependent on a single narrative. Physical ownership provides a form of insurance that paper instruments cannot replicate, particularly during periods of stress. Liquidity matters, but so does certainty. Silver's transformation from ignored industrial input to recognized macro asset did not happen overnight. It was earned through years of imbalance and neglect. Now that adjustment is underway, the market is responding as it always does when reality can no longer be ignored. The goal of long-term investing is not excitement or validation. It is the quiet accumulation of assets whose value becomes obvious over time. Silver's recent move suggests that this process has entered a new phase. Whether prices ultimately reach $100 or pause along the way is less important than understanding why the path exists at all. When markets correct long-standing distortions, they often do so faster than expected and longer than anticipated. Silver's recent performance fits that pattern. It is not a story about speculation. It is a story about arithmetic, patience, and the eventual recognition of reality.